Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cardinal Health Inc. quarterly report. Cardinal Health Inc. offers a diverse range of businesses and services to the healthcare industry. At its core, the company provides customized solutions for various healthcare providers, including hospitals, pharmacies, ambulatory surgery centers, clinical laboratories, physician offices, and patients at home. The company operates in two main segments: pharmaceutical and specialty solutions, and global medical products and distribution. In the pharmaceutical segment, Cardinal Health distributes branded and generic pharmaceuticals, specialty pharmaceuticals, and over-the-counter healthcare products to hospitals, pharmacies, and other healthcare providers. The company also provides services such as pharmacy management, repackaging of generic pharmaceuticals, and distribution of national brand products. In addition to its pharmaceutical business, the company offers a range of medical, surgical, and laboratory products and devices under its Cardinal Health branded line. These products include exam gloves, needles, syringes, compression products, wound care products, and urology products. The company also distributes a range of national brand products and provides supply chain services to hospitals and other healthcare providers. Furthermore, Cardinal Health offers specialized services such as the assembly and sale of sterile and non-sterile procedure kits, manufacturing, preparing, and delivering radiopharmaceuticals, and optimizing direct shipments through integrated technology solutions. With its extensive range of businesses and services, Cardinal Health plays a significant role in supporting the healthcare industry worldwide. Cardinal Health Inc.'s stock price skyrockets. A year of strong performance over the past year, Cardinal Health Inc.'s stock price has experienced a significant surge, increasing by approximately 88% from its 52-week low of $120.72 to an all-time high of $227.18 on February 5, 2026. Several key news events have contributed to this remarkable growth. One primary driver of this strong performance is Cardinal Health's consistent reporting of strong quarterly earnings that surpass analyst expectations. The company has consistently raised its fiscal year guidance, with notable announcements including a 19% increase in revenue and a 36% rise in non-GAAP diluted earnings per share, EPS, in the second quarter of fiscal year 2026. These results have led to multiple upward revisions of its fiscal year guidance. In addition to strong financial performance, Cardinal Health's growth in specialty solutions has been a significant factor in its stock price appreciation. The pharmaceutical and specialty solutions segment has demonstrated significant growth, with specialty revenues projected to exceed $50 billion in fiscal 2026. This focus on higher-margin specialty areas has been a key positive factor for investors. The company's strategic acquisitions and expansions have also contributed to its strong performance. Notable examples include the acquisition of Solaris Health, a leading urology MSO, and the expansion of its pharmaceutical distribution network through new logistics centers and forward distribution centers. Overall, Cardinal Health's stock price appreciation over the past year can be attributed to a combination of factors, including strong financial performance, strategic growth in specialty markets, and targeted expansions and acquisitions. These initiatives have collectively driven the company's stock price up by approximately 88% over the past year. Cardinal Health Inc. market capitalization of $54 billion is significantly larger than the average industry peer of roughly $4 billion. This shows that Cardinal Health Inc. holds a significant advantage in their industry. Cardinal Health Inc. trades at a higher price-to-earnings ratio of 33 times and a lower price-to-book ratio of -19.86 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 105% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. the equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the company's financial performance over time. According to the extracted summaries, revenue has been steadily increasing, with a notable surge in Q2 FY26, where it rose by 29% from the previous year. This trend continued into subsequent periods, with revenue growing by 5% and 4% in Q2 2023 and Q2 FY26 respectively. A closer look at segment performance reveals that certain areas are driving this growth. The pharmaceutical segment saw a significant increase of 5% compared to the same period last year, while the medical segment experienced a more modest rise of 3%. However, the specialty pharmaceuticals segment reported a decline of 2% in revenue during the same period. Overall, these figures suggest that the company's revenue growth is being driven by its pharmaceutical and medical segments. The steady increase in revenue across various periods indicates a stable and growing market for these products. The net income of a company has experienced fluctuations over the years. In Q2 FY25, the net earnings stood at $558 million. However, this figure decreased by 17% in Q2 FY26 to $467 million. A similar trend was observed in 2023, where the net earnings also dropped by 16% from the previous year to $467 million. This decline in net income suggests a decrease in profit margins. The company's profit margins have been impacted negatively over time. Although not explicitly stated for all periods, the available data indicates a downward trend. For instance, between the 6 months ended Dec 31, 2023 and 2024, profit margins decreased by 29%. This reduction can be attributed to various factors such as increased costs or reduced revenue growth. Based on the extracted summaries, it is clear that the company is generating a significant amount of positive operating cash flow. In fact, the operating cash flow was $1.4 billion in Q2 2023, which represents a notable increase of 14% compared to the same period last year. This positive trend in operating cash flow suggests that the company's financial health is improving, and it has the ability to generate sufficient funds from its core operations to meet its financial obligations. The fact that the company was able to achieve this level of operating cash flow despite a decline in net earnings indicates that it is efficiently managing its costs and optimizing its revenue streams. Overall, the data suggests that the company is on a solid footing financially, with a strong ability to generate positive operating cash flow. This bodes well for the company's future prospects and provides confidence in its ability to navigate any potential challenges ahead. The company's performance across various segments and regions has been mixed in the recent period. On a positive note, the pharmaceutical segment saw a significant increase of 5% in revenue, reaching $24.4 billion. Similarly, the medical segment also experienced growth, with a 3% rise in revenue to $10.3 billion. However, not all segments fared well. The specialty pharmaceuticals segment struggled, witnessing a decline of 2% in revenue compared to the same period last year, amounting to $10.1 billion. This dip in performance highlights areas where the company needs to focus its efforts and implement strategies for improvement. The company's financial activities involve strategic decisions regarding its assets. In terms of expansion, the company has made certain acquisitions, which are reflected in its financial reports. However, specific details about these acquisitions are limited. According to the extracted summaries, there is no clear information provided on the nature or value of these acquisitions. Nevertheless, it can be inferred that they have some impact on the company's operating earnings and net earnings, as amortization and other acquisition-related costs are excluded from these figures. In contrast to its acquisition activities, the company has not made any divestitures, which would involve selling off certain assets or business units. This suggests that the company is focused on growing through expansion rather than downsizing or restructuring its operations. The company's financial records reveal a consistent trend of dividend payments. On pages 5, 6, and 7, the extracted summaries indicate that dividends were declared in amounts totaling $128, minus $245, and minus $247 respectively. These figures are all negative, indicating that the company has indeed paid out dividends to its shareholders over this period. That concludes the financial summary for Cardinal Health, Inc. Feel free to comment below, and I will be happy to answer them when possible.